This will help you get wealthy quick. This will help you retire quicker. This won't. I'm gonna run some scenarios for you guys up on the board. The scenario I'm gonna run up for you right now is pretty, it gives you basically three options. Option one is you own the property, you don't have a loan on it. Option two is refinancing the property. And option three is doing a home equity line of credit on the property. And in the three options, I'm gonna go over the pros and the cons of those three options, okay? So option one we're gonna go through is a person has cash. Example is a $200,000 property, okay? So they have a $200,000 property, and a $200,000 property, I'm gonna give it very basic numbers. This doesn't mean this is a real market situation. This is only an example, all right? So if you have a $200,000 property, you have no money in your pocket, right? You put all your money into buying this property, it's paid cash. So in this scenario, $200,000 property, it's worth $200,000. You should be making about $2,000 a month rent. Now again, right now prices are very high, so it's really hard to do this, but normally I shoot for a 1% ratio, meaning the 1 month of rent is the property value. So then out of this, you're gonna have about 35% is the rule in expenses, okay? 35% of your expenses, your taxes, your insurance, all that stuff, and your maintenance. This is assuming the property is in good condition and doesn't need a lot of work, okay? So this is gonna be about $700, which leaves you $1,400 a month. So option one, you're bringing in $1,400 a month. In a year, that's what, 14,000, 28, that's $16,800 on a $200,000 loan. That's really good, assuming nothing breaks, no vacancy ratio, none of that stuff. That's really good, but really, that's not really the best return for your money, in my opinion. This is a little over 8%. It's a little over 8% on your money, cash on cash return. Now in this scenario, why I don't like this scenario, why I don't function this way, right? There's a lot of investors that are successful doing this type of investing. Why I don't do it is because when you're doing this style of investing, if the market tanks, you have no other cash, you can't buy any other deal. You're stuck. If the tenant leaves, and this is a single family home, you have no other income, so you're stuck. So even though you have cash, when the market tanks, it's hard to sell properties, so you're in a very difficult position because you can't make a lot of moves. It's also very difficult to get a loan because now when the market tanks, normally this property is gonna go from like 200 down to like 140 to 160K. So it's one of the two. So it's gonna be around that range. So it could go even lower in a bad neighborhood or not a strong financially strong neighborhood. Like for example, in very rural areas, even though they're not bad neighborhoods, they don't have a lot of potential buyers. So the point is, when you have 200K cash property, purchased at cash, it's very difficult for you to have much flexibility when the market goes down. Single tenant, return on investment is okay, but if you lose that tenant, you're not making much money. So option two is with a loan, okay? So with option two, you have a $200,000 property. So your loan on this property is probably gonna be about, let's say it's investment, you're probably gonna put down about 75%. So 150K loan, all right? And 50K is your cash in the deal. The rent is still the same, $2,000 a month. The expenses are still the same, 35%, okay? Which is roughly like, actually this is wrong over here. 35% is actually $700. In a $150,000 loan, principal and interest is going to be around $900 a month. So $400 is your net times 12 equals $4,800 a year. In both of these scenarios, I'm not including vacancy ratio or anything breaking because I'm trying to keep it very simple. Now this 48 divided by 50,000 is almost 10% return. And this was not accurate, I gotta fix it. It's actually 13, this is 15.6, and it's around 7.5, it's roughly around 7.5%. In this scenario is almost 10% return. So in the first scenario, all cash, you're making about 7.5% return on your asset. And you're making about 10% return on cash. So the two scenarios is your return on cash. I apologize, I'm a little distracted because there's some noise out here. So the point is, in this scenario, you're actually bringing a larger return on your cash. Now someone might say, Pascal, this is riskier because you have a loan. What I'm gonna say is, in reality, it's not as risky because one, you have more cash in your bank, so you have more room to do things. One, if the market goes down, you could buy more deals. Two, if there's vacancy, you can cover the expenses each month. With this example, you have no other money, or you have very little money to cover the expenses. And in this scenario, lastly, is if you got 4 properties in total with the same 200K, you'd be bringing in almost $20,000 a month, or $20,000 a year. Where in this example, you're bringing in about $15,000 a year. You're gonna be able to have at least 4 tenants bringing you in money. Where this other example, you only have 1 tenant bringing you in money. So if you lose 1 here, you got 3 others paying you. If you lose 1 here, you have no other tenants paying you. So in the last point of this is when you have 4 of these deals and you have 800K total, the average appreciation on a property is 3%. So 3% a year on this 200K is $6,000 in appreciation. In this example over here, it's gonna be about $24,000 a year in appreciation. So not only did you bring in almost $20,000 in rent, you also brought in $24,000 in depreciation. Appreciation. Property value going up on average, okay? So this will help you get wealthy quick. This will help you retire quicker. This won't. There's a lot of people who make it all cash, but most people, it's too difficult to do it this way. So again, in this scenario here, it's an example of cash versus having a loan. Now, initially you might think, okay, Pascal, what's a big deal? Between these two examples, there's not much difference. It's only $4,000 or $5,000 a year. You gotta understand that's $4,000 in rent, net rent income. Times 10 years, that's $40,000. You gotta think about it in 10-year cycles. It's $40,000 in additional cash to your pocket. The next thing is this. Right here is $24,000 in asset appreciation. Over 10 years, it's $240,000 in asset appreciation. If you did the cash model, you would have basically $60,000 in appreciation. So between these two people over 10 years, this one here gained an additional $40,000 in cash and $180,000 in appreciation. This person here that got the loan would be $220,000 wealthier. This is a rough example, but this is very close to how I model my investing. And this is how I do it. That's really the basics of it. Mike Reed, what about your third example? Awesome stuff so far. So in this third example is actually really going to be a two-part example. It's going to be the refining portion of this. Once you're in a few years later, you're going to be doing refis. So I'm going to be showing that to you. And then should you do a regular refi, or should you do a home equity line of credit, or should you do a hybrid? Let's keep the scenario the same, right? This is the scenario. You purchased this $200,000 property. Let's just say you kept it, you bought it in a good area. So in 5 years, this property is worth $300,000. Partially because you did some stuff yourself, you painted it, you fixed it up, so on. Or your investment group painted it, fixed it up, did basic things but made it look nicer. So now the property is worth $300,000. Okay? This is an owner-occupied multi-unit property, okay? Now the loan is about $150,000, like we said. We'll just keep it simple. We're not gonna account like the loan got paid down over the 5 years and so on. We're just gonna keep it flat, we'll keep it simple to keep the number simple. So the property you purchased it for $200,000, loan of $150,000, and current market value is $300,000. So the question is, what should you do in this scenario? So option one is obviously do nothing. So I don't really need to run numbers on that, do nothing. Option two is I would refinance the first mortgage, $150,000 refi. I would go from, right now I'm going from 4.99% to 2.69%. In this scenario, I would save roughly $200 a month. This is times 12, $2,400 saved. And then I still have remaining here, because in an owner-occupied property, you can go up to 89.9% roughly in most markets. So the max loan amount is $270,000. 270 minus 150, you can get a HELOC, a second loan, for $120,000. $120,000, and normally the closing, you don't have any closing costs on a home equity line of credit, or it's like $500. It's very small. $120,000 line of credit, if you don't take any of the money out, additional payments are $0. If you take the money out, normally it's around 4 to 5% loan. So let's say 5%, it's $6,000 a year. So it'd be $6,000 for you to use the money. But if you're, which is a negative figure, but if you're looking and you do well, like I do, I normally make about 20 to 25% on my money. So even though it cost me 5%, let's just say I make 20% of my money, I would make $224,000 additional with this money. So I would make a net positive $18,000. So you saved $2,400 and you made $18,000 on this refi. So an option two though would be not to do a home equity line of credit, which is just to do a cash out refi. And a cash out refi in a home owner occupied property will allow you to go to 80%. So this new loan is not $150,000. At 80% of this figure is $240,000. $240,000. You're taking $150,000 to pay off your first loan, and you're paying all the closing costs. We're gonna make it all equal because you had closing costs here, you had closing costs there. The issue now, and why I don't like the second option, it's very rare that I like the second option, is because the closing cost now, when you're doing cash out, can sometimes be around $5,000 additional closing costs. So to get this $90,000, which is nice, will cost you $5,000 extra in closing costs. So you would get $85,000. I would be able to do the same thing here and get a home equity line of credit for the difference. But the difference between these two options is $5,000 extra in closing costs. which I would try to avoid having to spend. It's very rare. Sometimes I will go this way. I have to determine, I have to review the financials to give you that answer. But in this scenario, you're getting $85,000 cash. You would then still get a home equity line of credit for the other 10%, which is going to be another $30K on the HELOC. And you'll be able to reinvest that money, and your return on investment would be similar to this one over here, except it cost you $5,000 more to get the loan. There is slight differences, but this is the main difference, is paying the $5,000 extra. Now, one other thing is, with this one here, because you have this first loan is now $240,000, you're paying principal as well when you do a full refi. On a home equity line of credit, normally, and you should always try to do this, normally they're interest only. So when you do that, your net payments are lower with this option than this option. So actually, with this option as well, you have a higher cash flow. So a lot of this is going to be like, that's a lot of data. I'm going to agree with you. That's a lot of data. But you have to constantly run your numbers, and then this is going to make more sense. Because if you run your numbers enough time, you're going to start realizing, okay, I see what he's saying. I already ran the numbers out before, and I get what he's saying.